My target on gold is 7,000. My target on silver now is 200. Um, so particularly silver, being where it is down just under 60, if it can go from 60 to 200 this year, and maybe even faster than the end of the year, that's pretty steep. And gold, obviously, if it can go from 4,000 to 7,000, would be an unbelievable move. So that's what I'm seeing, and that's what I expect. I realize there's lots of people out there in that field, people that follow gold and silver closely, who think they both have more to go. The breakout in silver was 50. Gold looks like it could go back 3,500. And so I can't say that's impossible, certainly, until this thing really gets turned around and you start seeing a little more upside. There's always a risk that, this is just another dead cat bounce and it goes lower. I think, based on what I see in sentiment and what I see in the charts and everything, there's a pretty good chance we came down to a trend line on silver, and gold looks like 4,000 or 3,900 is a pretty good place. And ironically, and I didn't do it for this reason, but if my numbers, and my numbers may not be right, but if my numbers are right, 200 on silver to get back down to 50 would be about 75%, and it would be exactly 75%. That would be, kind of a normal in the, if I'm right about what equity is going to do and what we're heading for in terms of global bust. Silver is a very cyclical metal, and it will get hit almost as hard as equities. 75% would make sense to me. That would take you back to that 50 breakout point that all these technicians think is necessary to get going. So you could have it, but not have it now and have it later. Got down to 56 in this correction. Gold, from 7,000 to 3,500 is 50%. 50% retracement would be a very normal retracement in anything, but in gold, certainly that would make sense. So whether those numbers are right or not, I didn't get to my numbers that way, but the other day I just said, oh, those are convenient, kind of places where it could correct from. So I think the possibility is that all those people waiting here for that last shoe to drop, as often the market doesn't accommodate, you take off from here and you get to those breakouts, those natural places where it should go down to in the bust rather than now.
Well, your target of 7,000 an ounce for gold is actually bearish compared to some of the analysts I've spoken with who are calling for over 10,000 an ounce, with a plan for the Fed, for the government to actually revalue the gold on the balance sheet in order to maybe address the debt or to participate in some kind of monetary reordering like a Bretton Woods 2, which Treasury Secretary Scott Bessent has actually alluded to in some of his writing and speeches from years past. Like, do you think that that might be a plan going forward to revalue the gold?
I know there's been talk of things like that, and certainly a lot of speculation in markets about that. Um, I guess my feeling is that we're too close to the bust for anything like that, because that's going to take time. You just don't all of a sudden roll out, we're revaluing gold, and I'm not sure how we do that exactly anyway. It's not like we're in charge of that. Um, so I'm skeptical of that. Certainly skeptical of it happening before a bust. Um, I by the way, I do have a $20,000 target for gold. It's just that I think that comes in the next cycle when we have all that money going to work. It drives the next cycle is going to be a commodity cycle, an inflation cycle, and I think gold and silver are going to be the top performers in that, or among the top performers. So I have silver going to 1,000 and gold going to 20,000, just not this cycle.
Okay.
So I'll top them, but just not now.
Got it.
um, so,
What about treasuries? Let's talk about treasuries a little bit. One of the interesting statistics that I saw, I think it actually came out of a Fed paper, was that like 34% around there of the issuance is being purchased by Cayman Islands funds, which
really?
looks, yeah, which looks like a little bit like, okay, well, we're running out of foreign buyers, and now a ton of the demand is coming from levered funds in the Cayman Islands that might have to sell if there's any issue with risk on stocks. So I don't know. I feel like there's some tremors there that might crack open.
Yeah, I hadn't heard that. I might turn it around another way, which maybe it doesn't work with the levered funds, but it might be wealthy investors who are running to the safety of treasuries here, see a bargain, because I do think the bond market is bottoming, um, and saying, and it may be more a sign of how bearish they are about the stock market, which I keep arguing is that wall of worry that's going to keep it going here. So yeah, I don't know enough about it to know who the buyers are there, but it may not be the conspiracy everybody thinks it is. We are approaching a 3-year bottom in bonds. They fell. I think it was October of 2023. So we're that's the anniversary for us. The being along the bottom here. I think this is a major bottom from which we will see a major bull market in bonds and obviously a drop in a rollover in rates. So I'm thinking because the economy is slowing, and I was pretty alone out there saying I think inflation, the trend in inflation is still down. That sometime in the next few months we'll see the trend reassert itself on the downside. Well, we got that this week with the CPI and PPI, and I think the New York Fed president this morning in comments in a speech he had said it's possible we may have seen the peak in inflation back in May or June, and that we are rolling over. So, and I agree with that. So I think it coincides with a bottom in bonds and a top in rates. And my rate forecast hasn't changed probably since we talked last. I still think in the bust you could see a 0% 10-year, negative short rates, and probably the 30-year down to a 0.5%. And basically it would be one last lower low in rates, higher high in bonds, before we embark on a huge bear market, because next cycle is inflation to the numbers I talked about. So you could see, 20 probably 25% short rates and close to 20% long rates, if inflation goes to 25%. The next cycle. So that wouldn't be until probably 2032 or three, but it would be moving up in that direction throughout that cycle.
It's super fascinating. And by the way, yes, it says that the findings suggest that Cayman Islands hedge funds are the marginal foreign buyers. They're U.S. firms domiciled there, and they absorb 37% of net issuance of notes and
Wow.
bonds, which is
If
pretty
yeah,
crazy.
I think it's been reported that I think I have this right that the hedge funds, if they weren't record short, they were certainly very short the stock market in recent months. So this is kind of the other side of that trade. It tells you where they're putting their money. So it may not be, like I said, it may not be anything to do with foreign sellers and
Mhm.
people bailing out of treasuries, and somebody else stepping in to kind of make sure it doesn't get out of hand. I think it's probably more natural buyers. I keep saying hedge funds aren't the smart money everybody thinks they are. I mean, except here. I mean, they are buying bonds short term, but I don't agree with their short the market story. So
Well, it seemed like the concern was the highly levered basis trade, and we also saw that sort of unwind with the carry trade with the yen, right? But it's interesting to see what's played out with Japan, because that seems like an area where things could blow up and have a domino effect. But increased rates, and like we kind of feel like we're at that spear tip, and then all of a sudden things calm down again. And I feel like we've had that sort of whiplash of, oh my gosh, is this going to break it? No, it doesn't. It calms down. Oh my gosh, the Iran war breaks out. Is that going to break it? No, it calms back down. Like, I think that's why it's led to a lot of confusion with
and it's
investors.
also a sign of I've said people the institutions have had one foot out the door to the stock market, since October 2022 and before, obviously. But I mean, they just have been skeptical of this all the way up. And institutions obviously look at valuation a lot,
Mm.
and it's been hard, even though there's half the market was really undervalued. Because of what was going on, and if you looked at the PE multiples on the market, you go, we have all these problems, and yet we're at highs on market multiple in the mid 20s. a year ago. So I get their skepticism, but they've missed so much because of that. And Japan, I agree with. I think Japan is a potential trouble spot in the
Yeah.
bust. As I say, it's a global bust, and it's been remarkable that they've been able to keep their game going for as long as they have. Of
Right.
because normally, because what they're having to do is print money to keep rates low, and as I said, ultimately rates are controlled by the markets, not by the Fed or by the central banks. You print money, ultimately with a lag, it turns into inflation, and if inflation breaks out, rates break out. And they're just beginning. That's why everybody's so nervous, because I think that's beginning to finally happen. They were
Hmm.
for so long. You go, what's the lag? Well, how can they keep monetizing their debt
Hmm.
and not have inflation?
Right.
But it's because it was a homogeneous, very efficient economy, and they were able to do it. But now we're seeing rates begin at the very low levels, break out. If inflation does there what it does anywhere it's ever done it breaks out and starts going vertical, it's lights out. I mean, they're so levered to that
Hmm.
low interest rate situation. That being said, I struggle with this idea that there's some big carry trade blow up over there, because that happened in August of whatever year that was, 24 probably. And I just People aren't that stupid that they saw what happened there. I don't think you have nearly that levered trade there now. There's one, there's some, I'm sure, because rates are still low over there, but I don't think that's the big blow up. But if rates break out there, their whole economy and their government is in trouble, because they can't afford, with what they how levered they are. They can't afford rates to go a lot higher.
Right.
So I think that is going to be a story in the bust, likely, unless rates turn down and it bails them out
Yeah.
somehow. But
Right. Yeah, I think
uh,
they have over 200% debt to GDP.